Welcome back to Explain the Charts, your go-to source for unbiased market insights. Today, August 1st, 2025, we're breaking down the recent dramatic shifts in the S&P 500, ticker SPY, and connecting the dots between current events and chart patterns. Just yesterday, the market closed on a sour note, largely driven by President Trump's sweeping new tariffs and a significant earnings flub from Amazon, as reported by Yahoo Finance and CNBC. These headlines sparked immediate concern, with Dow and S&P 500 futures slumping and Amazon shares tumbling over 7% post-announcement, directly impacting the broader index. Let's start our deep dive by looking at the daily chart for SPY to get an overarching view of its recent performance. As we zoom out on the one-day chart for SPY, we can clearly see that despite the recent slump, the index had a solid run leading up to yesterday's close. The S&P 500 has been in a strong uptrend throughout much of 2024 and 2025, hitting new highs, which aligns with reports of a 12.2% average annual return over the past decade, significantly above its historical average. However, a recent Nasdaq article highlighted the S&P 500's cyclically adjusted price-to-earnings or CAPE ratio being near its highest point since the dot-com bubble, suggesting a potential short-term decline or plateau for valuation to revert to historical norms. This is exactly what we might be seeing play out in the latest candles, especially the sharp drop on July 31st, which closed at 632.08, a significant pullback from its recent highs. The July 31st candle, opening at 639.455 and closing at 632.08, marks a substantial 1.15% decline with extremely high volume of over 103 million transactions, indicating strong selling pressure. This single candle wiped out gains from the previous 3 trading days, illustrating the immediate market reaction to the negative news. Now, let's narrow our focus to the past few days on the 1-hour chart to understand the intraday dynamics of this downturn. Looking at the period from July 28th through July 31st, we observe that after a relatively stable Monday and Tuesday around the 635 to 637 range, the market saw increasing volatility. On July 30th, the SPY experienced a sharp hourly drop from highs around 637.68, plummeting to 631.54 within hours, followed by a bounce, but ultimately closing lower than its opening. This volatility escalated further on July 31st, with multiple attempts to breach resistance levels quickly rejected, culminating in the significant afternoon sell-off. We can identify an immediate support level around the 631.54 mark, which was tested and briefly broken on July 30th, acting as a crucial line in the sand for short-term traders. Let's zoom even further into the 15-minute chart for July 31st to capture the granular details of yesterday's sell-off. Notice the sharp decline that began in the afternoon, particularly after the 1713 Universal Time Coordinated Candle, accelerating downwards. The initial break below 637.00 acted as a critical resistance, signaling a strong bearish momentum, with subsequent candles rapidly pushing the price towards the 631.00 level. The heavy volume during these periods confirms strong institutional selling, overwhelming any buying efforts. For day traders, spotting this high volume on down candles after a resistance break would have been a clear signal to consider short positions. Returning to the daily chart, the overall trend for SPY remains upward on a longer time frame, suggesting that this sharp pullback might be a healthy correction rather than a full reversal. Key price levels to watch now include the immediate support at approximately 630.00, which, if broken, could lead to a test of the next significant support zone around 620 to 622. A breach below 620 could trigger further downside towards the 600 psychological level, which historically has provided strong support. Conversely, for the bulls, a quick reclaim of the 635 to 637 range, accompanied by strong volume, would indicate that the sell-off was overdone, potentially signaling a short-term reversal. Reasons to be bearish include the recent tariff announcements, Amazon's disappointing earnings, and the elevated CAPE ratio suggesting overvaluation in the short term, alongside the significant bearish engulfing candle on July 31st. The looming jobs report, mentioned in the news as a key upcoming event, could also be a significant catalyst for better or worse. However, long-term bullish sentiment is underpinned by broader economic growth, technological advancements, particularly in AI, which analysts predict will significantly boost the economy by 2030. This long-term perspective encourages buying into dips, adhering to the principle of buying slowly and holding through volatility, as history suggests the S&P 500 tends to deliver strong returns over extended periods. In the short term, traders should monitor for high-volume reversals around key support levels and any positive surprises from economic data or corporate earnings. The balance between this short-term uncertainty from tariffs and tech news and the long-term growth story is what makes SPY fascinating right now. Remember, volatility is part of the game. Managing risk and understanding these critical price levels is paramount, especially around major news events like the upcoming jobs report. Unbiased predictions. It is likely, with about a 60% probability, that SPY will retest the 620 to 622 support zone if the 630 level fails to hold. This would be reinforced by any further negative news or a weak jobs report. A rebound to challenge the 637 high is possible, with about a 40% probability, if the market shrugs off the recent news and the jobs report provides positive economic data. Always look for confirming candlestick patterns and volume trends at these key levels before making trading decisions. Stay vigilant for the jobs report results, as they will undoubtedly set the tone for next week's trading.